I'm going to try to convince you to raise less money in your pre-seed round. I'm going to present some data and some recommendations on what to do instead in terms of how much money that you're going to raise. And hopefully you see a different way that's going to prevent you from experiencing a lot of the frustrations that I see from many founders out there, especially in today's market. Before we continue, my name is Ed Keng. If we met before, welcome back to my channel. Thanks for coming back. As always, use the chapter markers to skip right ahead to the good part of the video. If we haven't met before, welcome to my channel. I'm a 7-time funded founder with 2 exits, and that's just a fancy way of saying I failed a bunch of times to your benefit, because I like to use my YouTube videos to help founders of all stages, especially early stage founders raising early stage capital, avoid some of the catastrophic mistakes that I've made. It's not to say that you're not going to make mistakes, but I'm going to try to make your life a little bit easier because it's tough enough as it is. I have raised over $100 million from my startups, other people's startups, as well as startup funds, and I'm the Chief Strategy Officer at Startups.com, where our team has helped founders raise over $750 million for startups that have gone on to raise billions of dollars more. And that's where I'm coming from. So if you haven't checked us out at Startups.com, head on over there. Easy URL to remember, a lot of free resources. If you're already a member, thank you so much for your support. Appreciate you being part of the community. While everyone's here, do the YouTube thing, like, comment, subscribe. Always helpful. Now let's jump into why you should be raising less during your pre-seed round. Our friends at Carta are very helpful in publishing these regular reports in terms of funding rounds. And they said in Q1 2025, pre-seed funding declined for the 3rd consecutive quarter. Now, if you know anything about looking at trends, anytime there are 3 sessions moving in the same direction, that is a trend that you have to pay attention to. The data tells us there's a continued decline in pre-seed activity. For the 3rd consecutive quarter, pre-seed investments declined in terms of both total cash raised and count of instruments. Q1 saw a total of $737 million invested, down 20% from Q4's $923 million. Now, you're probably thinking, how does this affect the total amount of money that I raised? Well, here's what happens at Startups.com and a lot of founders that I talk to. They start off by saying, I want to raise $2 million in pre-seed. And my response is, well, that might be a little difficult. $2 million is a lot. And I explain to them, statistically speaking, the average pre-seed round for the past few years has been between $500,000 to $1.5 million. And so founders say, great, thanks, Ed. Thanks for giving me that information. I'm going to lower my raise to $1.5 million. And I say, well, it's still going to be a little difficult as I look at their startup, and I have the benefit of seeing dozens of founders. In fact, almost 400 founders right now that I work with, the majority of them are trying to raise pre-seed funding. Now, getting back to that $737 million, founders may say, well, Ed, I'm just going to be part of that $737 million, and I'm going to raise $1.5 million because that's what I need. And you can raise as much as you want at any point in time, and I always say, every founder has a better than 0% chance of building a unicorn and raising that type of level of venture capital. The question is, how difficult do you want your life to be? To explore this topic, let's look at this next chart. It says pre-seed round larger than $1 million declined more sharply in Q1 2025 than rounds under $1 million. And you can look at all that data there. In fact, just go to Carta. I'll link it in the description and you can find this report yourself. The takeaway is that smaller rounds continue to make up a larger percentage of all pre-seed rounds. Q1 2024 had nearly 3,800 rounds under 1 million and 2,900 rounds above 1 million, while Q1 2025 had 3,400 under 1 million and only 1,700 above 1 million. Statistically, we went from 3,800 rounds under 1 million to 3,400 rounds under 1 million. That was only a drop-off of 400 rounds, roughly just above 10%. But if you look at the other rounds above 1 million, we dropped from 2,900 to 1,700. That's a much steeper decline, and we have to pay attention to this. Now, I want you to consider where this data comes from. It comes from Carta. Serious founders raising institutional rounds use Carta, and that's what they do to track their cap tables, and this is where you get this reporting. If you're raising over $1 million, last quarter, there were only 1,700 rounds completed at that raise amount. Think about how many founders are out there trying to raise over $1 million. I can tell you it is an order of magnitude more than 1,700, and many of them need those checks right away. They need that round to close in that quarter. I talk to founders all the time. You all come to me and you tell me we need to raise capital right away. And that's a huge mistake. You're raising capital when you only have 3 months runway. So you've only got a quarter to close that round. And guess what? It's going to be very difficult because there's so much competition. And right now, because of the investment environment and that competition, investors are going to what's called a flight to quality. They are going for pedigree startups with already significant amounts of traction. So you have to be thinking to yourself, do I have enough traction to validate my startup idea, de-risk it enough, at the same time compete with other founders with all that traction? You have to take a good hard look and be realistic about it. Now, let's say I've convinced you already and you're going to raise less than 1 million. The same numbers apply. Only 3,400 checks were written. How much competition is out there for you? That leaves you with raising a friends, family, and associates round, or associate could be generous angels. And most of those rounds, those types of investors are not reported in Carta. But think for a moment, how many associates or how many family members do you know, friends or generous angels, who most likely aren't full-time professional investors? How many of them can write you a check for $1 million or write you a check for $100,000, $200,000? And this is when you can't attract that money from VC because it's so competitive and the goalposts have moved. They're looking for significantly more traction, more pedigree, more everything to justify writing you that check in this depressed environment where things are not going well in terms of investor liquidity. Think about that just for a moment. Then you're going to friends, family, and associates, and the checks are going to be smaller, and immediately you're outside of the range of what we're reporting, and then it becomes the wild, wild west out there. Now, let's entertain another scenario. You have a generous friend who's an angel investor who's ready to write you a $50,000 check. If you're raising $1 million, that is a drop in the bucket. Consider this scenario. You need to raise $1 million because what you've done is you plan your entire use of funds, all your spend on hiring these engineers, paying yourself a nice swanky 6-figure salary, and all the expenses for customer acquisition that you have to go figure out and you're going to spend on. That $50,000 is going to come in, and like I said, it's a drop in the bucket. So if you need $1 million to execute your plan and you get $50,000 offer, what are you going to do? Are you going to take it? Most likely, you shouldn't take it because that money isn't going to move the needle whatsoever. And if you go take that money and you lose it, you're just going to have another angry investor that's most likely close to you as a friends, family, or associate type investor, and that's not a situation that you want to be in. This brings us to the concept of a lead investor. Many VCs or institutional investors will say, great, we're in, but we want you to find a lead investor. A lead investor is an organization, an individual entity that does most of the due diligence and puts in most of the money. So if you're raising $1 million, you need a lead investor to put in $500,000, $600,000. It has to be the majority share of the money, so that sends a signal to the other investors, well, if they're willing to put in their $500,000, we'll put in our $100,000 or $200,000. That's how it works. Your $50,000 investor is not considered a lead. It doesn't even help convince those investors because they believe, yes, we appreciate you as a founder. You're willing to go take money from friends, family, and associates. That shows the type of founder you are, but it doesn't help understand or validate whether that idea, your startup, is going to be successful and make the 10, 20, 30, 100x return that investors need to see. If they have LPs, they're managing a fund, they need to hit it out of the park because 90% of startups fail. Just think about these factors for a moment as I present what I think you should do. I present to you the 10x rule and I urge you to consider it. This is a rule that I personally use when raising funding that I believe has helped me become successful. And I also use as an investor, as a general partner, associate analyst. I played all the roles in evaluating other startups in terms of what to fund. The 10x rule is multiply what you're asking for by 10 in terms of revenue and be realistic. In other words, can you prove it to investors? In other words, if you're raising $250,000, you need to know how to get to $2.5 million. $500,000, $5 million. $1 million, $10 million, and let's go to the upper echelon of the band, $1.5 million, as many founders are trying to raise. That has to create $50 million in revenue. Take a deep, hard, long look at those numbers and ask yourself, do I realistically know how to get there, and will investors believe me? If by now I haven't scared you away and caused you to unsubscribe from my channel, hear me out just for a moment. I'm not saying if you're raising $250,000 times 10, you have to get to $2.5 million right away before you raise your next round. But think about what investors are looking for. They are looking for 10xers, one order of magnitude better opportunities in better companies that are that 10x better than what's out there. And that includes revenue acceleration. Right now, with AI, we are watching founders reach $1 million ARR in literally 12 months. We're seeing them reach $100,000 in MRR in like 3 months. That's the competition that you're facing, and those are the types of investments that those investors experience FOMO with, and greed starts to set in, and they want to start writing checks. You may take that $250,000 and you get to $1 million, and those other checks are already going to start coming in. By that time, you should be thinking about fundraising anyway. If you're trying to go unicorn, you're building that type of startup. But let's look at the optionality. If you raise $250,000 and you're on your way to $2.5 million, do you really have to be raising any more funding? You might not. Instead of building a unicorn with a U, you might be building a unicorn, Y-O unicorn, that fits you and your goals. This opens the door for seed strapping and a whole bunch of other things like debt financing, non-dilutive funding, and that's the situation that we want all of you founders to be in. But the most important part is the investor must believe that you know what it takes to make it to that $2.5 million. Let's go to the other side. You're raising $1.5 million for your pre-seed. You have to ask yourself, do you have enough to demonstrate to the investor to make them believe that you're on your way to $15 million? Once again, venture capital is a subset of private equity in a very volatile asset, alternative asset, but has the asymmetric upside of 10xing, 100xing, 300xing anybody's investment. That's what they want to invest in. That's why you have to be thinking at this level of numbers. It's much more difficult to convince someone to write you a $1.5 million check or 3 investors to write $500,000 checks than someone to write you a $50,000 check. Not to mention, if you're looking for a lead investor, you need a $750,000 check or $1 million check to send that lead investor signal to other investors so they jump on. If I had my way, I'd make every founder raise $250,000 or $500,000 if you're in a special case. Remember, for the past few years, AI has sucked up all the oxygen out of the room. Valuations have gone crazy. People are throwing money all over the place. So it's very common to raise $1 million, $1.5 million. And that's what's tipped the scale and made it a little bit of a red herring, a little bit of a false signal for other founders if you're not raising for ventures in AI. So let's get back to that generous angel who's going to write you a $50,000 check. You've got a $250,000 spend, use of funds with a solid plan for $2.5 million. $50,000 is 20% of the way there. All you need to do is go raise another $50,000 from 4 other investors. That's a lot different than trying to raise $100,000, $200,000, $750,000 checks from VCs. And if you experience this in any shape or form, you know what it's like to try and contact all these VCs when everybody is pitching them and they've got high standards, how infuriating, insufferable, and thankless the process is. Let me share a personal story. I raised $245,000 from friends, family, and associates, angels, including some crowdfunding for a venture. And we started using it, and I refused to raise more money. Why? We had no signs of product market fit. Yes, we were making revenue, but not at the momentum, the velocity that investors needed to see. I started off as an angel investor, and they invited me to be the CEO. And I told them we are going to bootstrap, and we need to minimize our burn, and we need to do some adjustments on the cap table because I was having a lot of struggles with my co-founder. Well, they were not happy with me unwilling to go and raise more money because their salaries were on the line. They saw different bills coming up and they said, how are we going to pay for all this? We're used to this level of operation. I said, tough. We have to figure this out or there's no point in raising more money at a bad valuation, doing it down round, junking up our cap table to the point where, let's say we do get to a seed or an A round, we're not going to have enough room on the pie to even attract those investors because we're taking all this money and we're throwing good money after bad money. The result, the startup shut down. But that was after they pushed me out. The one co-founder went and got the board to turn on me and they moved me out. And I was actually glad to get out of there, even though it was one of the hardest divorces that I've ever had in a startup, because I was not on the hook for that money. I could put my head on my pillow at night and sleep peacefully and have integrity about the entire issue because I left that company with significant amounts of capital still in the war chest that they completely burned through. That's why I recommend using the 10X rule, because it helped me avoid some sticky situations. It also keeps me accountable that if I am going to go raise money, I don't arbitrarily slap a number on because engineers are expensive and I will spend a lot of money on paid advertising. I carefully plan it out and I know my plan. And if I can raise that amount of money and 10x it, well, all the options are open to me. And I like being in that power position. I want to know that investors need me more than I need them. And if I'm 10xing investors' money, guess what? I will never have to work hard to get an investor interested in my company. I just have to work hard on building my company. Did I convince you? Well, if history on my channel has been any of an indicator, maybe some of you, the majority of you, need to think about it. If so, I want you to watch the video that I'm put on the screen that's going to help you determine how much to raise. If you are hell-bent on raising more capital during your pre-seed round, talks about what to raise during a seed round as well. I hope that it's helpful, and I've got a lot of other videos on my channel. Let me know what you think, and I appreciate you spending the time with me and being open-minded. I'll see you in the next video.